Good day, fellow deal makers. Welcome back. This is part two. Every once in a while, we go from a 7-minute chat to more of a long form story because in our 7-minute chat, there's things that I want to dig in more. And as a deal maker myself, and I know you guys might have these questions, so I invite the guests to kind of hang out for a little bit more and go back to the recording. So if you are interested in listening to the 7-minute chat, right, the deal chat, you could go to the links below and go listen to that 7 minutes to see if this interview will be of interest to you. We're going to talk about a few things here is investing in American made. We're going to talk about listing. We're going to, taking a company public. We're going to talk about taking a public company private, and then also a direct listing. So if those are of interest to you, hang in there. We're going to have a good chat. So, Aaron, welcome back to the Deal Scout round number 2.
Thanks. I'm pleased to be here.
Yeah, so we won't go through the intro again because people can go back and dive in. But Modiv Industrial, right? We're talking about a publicly traded company that you guys buy manufacturing groups here in the U.S., and you've been doing that for a little bit. Talk to us about some of the success you found with Modiv.
Yeah, so Modiv actually started out as a different business. Going back to 2018, I joined the company that was prior to Modiv. Modiv, in its earlier form, was a real estate crowdfunding company called Rich Uncles. And Rich Uncles was formed right after the Jobs Act. And if you know about, as you know, you've covered real estate crowdfunding in great length, investors would go directly online without any financial intermediary. They would go directly online and would make an investment in this. So this company started, the founders of this company started it back in 2013. They formed a California REIT that was focused on net lease, and then they formed a national REIT. And by the time I had come, the opportunity presented itself to really transform it. And so what we did is we merged the two REITs together, and it was an external manager, and we internalized that. And that all happened at the end of 19. And then you flash forward about a year until the beginning of 21, that's when we became Modiv. And Modiv stands for monthly dividends. It's what we believed in. We think it's really important. These are hard-earned dollars that are put to work, and a lot of them rely on the dividend. And, it's like a paycheck. And we have that cadence in life, right? We have our monthly mortgage, and we have a lot of things like that. So that's how we started. And then we started shifting the portfolio. We started selling the non-core assets that were retail and office and buying more industrial. We really focused on the unique opportunity of industrial manufacturing. Not only is it attractive from a yield perspective, but we fundamentally like it from a personality perspective. And we talk about that in our most recent press release. And then as we move forward, we did what was called a listed preferred. So we have a preferred that's listed out there called MDV.PA. And we also have our stock. So when we listed our preferred, we did $50 million of this in September of 21. And the receptivity was strong. I could have sold $100 million that day. We didn't. We wanted to be prudent. We didn't need too much money. And having been in the REIT industry for quite some time, and having taken a prior company, a student housing REIT private, and taking another net lease REIT public, and then selling it to another REIT, had been in the space, know the REIT players for a long time. When we listed our preferred, they said, you guys should take your comment, because we were already publicly filing Qs and Ks for many, many years, but we weren't traded. We were one of those non-traded REITs, just like Blackstone REIT. So we said, yeah, we're going to do this. So we were getting ready. This was back when the market was still really strong. We're getting ready. We thought we're going to do an IPO, maybe 100 million, 150. Though we didn't need the money, we thought we were going to do that route. We got ourselves all ready. The end of January of 2022, market starts to crumble a little bit. REITs are starting to take it on the chin. The banker we had said, hey, why don't you wait till after the March Fed meeting? I'm like, my gut doesn't feel that's a good sign. Let's just list. So we listed all our shares. We have about 11 million shares outstanding. We listed those. We did not lock them up. Typically, when you go from a non-traded REIT to a publicly traded REIT, what happens is the bankers say, lock your investors up so they can't sell their shares. Well, we didn't think that was fair. Right? This is their money. They need to be able to do what they want to. So we didn't lock them up. And that's what we did. We listed our company. We've been fighting every day for the last 2 years. That was 2 weeks before Putin invaded Ukraine, we listed, right? About 4 weeks before the Fed started raising rates at a, calamitous rate. It's been a crazy 2 years, and we've only gotten stronger, cleaned our story up even more. And in the last year, our stock has produced a 40% return.
Wow. So Aaron, you guys, you went unconventional in a few things. One is you didn't do a lockup period, right, for your investors. You went public. What was your offer price when you guys went out there? What was
25, which was below our net asset value. And we've taken it to the chin right now. We're trading, our stock, our liquidation value is probably around that price, probably a little bit less now because the market's gotten softer, but it's north of 20. And we trade it, I don't know, today we might be right under $15.
Yeah.
We did the right thing for investors by not locking them up, but that hurt the share price.
Yeah, because some investors who didn't have the long-term vision in that, they got out right off the bat
Right away.
and the stock plummets, right? Like, and for the CEO, of these kind of groups, what was going through your mind when you saw, all right, we open at 25, this is cool. Hey, I'm doing everything for the investor, right? We're going to do monthly dividends. We're not going to do a lockup. And then you see that dip. What's going through your brain when that happens?
Well, it was even more crazy. So if you ever look at our chart, and I'm glad I get a chance to tell this story, because we came out at 25. The first day we closed at 80.
Whoa.
Right?
Boom.
Boom. The next day, 60. Here's the weird thing. There were no shares to trade. There were no shares we didn't offer any shares to trade. There were no shares trading. What we found out is that in this market, a dealer has a 5-day settlement period instead of a 3-day. So if you go in the stock market and buy your shares, you got to provide the funds right away, or you're going to have shares if you're selling short deliver right away. They have extra days to go get that inventory. So someone wanted to buy the shares. They sold them to them. They didn't have possession of, knowing that they would get them in time. About 6,000 shares traded hands multiple times a day, all the way up. People thought we were a tech company. We were hashtag or $ Modiv was trading along with Roblox and Tesla day. We shut up. So that made it even worse for our investors who on the third day could sell their shares, and they're seeing 60 and 80. They just put market orders in, flooded it, right? And I get it. If I had stock, it was at 25 and suddenly it's worth 60, I'm going to sell.
Yeah.
And they sold and there was no volume and it just crushed. And we've been hit ever since then. And so what was going through my mind was, what the heck is going on here? Why no REIT should be worth $80 if it's valued at 25? And it's been a fight, but luckily we're fighters, right? There's 11 of us at this company. We're all battle born. We know what we're doing, and it's been a fight. And you got to do what's right for investors. And the long-term investor, it's getting their dividends, closing the value gap. We will work diligently to close that value gap, or someone will buy us and close it out.
Yeah. So when I look at my stock account and my app, right, I love trading, right? Like it's fun for me. And I love it when I see this huge spike, right? I'm like, oh, on paper, right, man. And then, like if I don't sell at the right time and it goes down, I'm looking at, my, this is ridiculous that I look at it this way, but sometimes my net worth in terms of that stock app or whatever, attached to my worth. Right? Like my self-worth. Yeah. So you see this going up. You've got all your own, preferred stuff, and you see it go up to 80, dude. In your head, you're the king of the world, right? What was
I didn't think that. I thought that was a fluke, because that didn't make sense to me. Just like when it's trading where it is now, it doesn't make sense to me. Right? I know where intrinsic value is. And so I'm a fair guy. If the stock price is trading well above where it should, people should sell it, take their profits, because it's dislocated in price. If it's well below where it's traded, they should buy it, and they should be prepared to make their profits. Long run, I believe that the equity markets are more efficient than not. In the short run, they're very inefficient, right? Yeah. If you look at REITs, you look at our name, it trades like this all the time. Someone, if they were savvy enough, could probably make some money on that. I'm a longer term investor. I love to trade on the margin of different names, obviously, but I'm a long-term investor. I keep reinvesting in myself, because real estate is about income. A lot of times people make it about speculation. You can speculate in the stock, you can speculate on trade, but really real estate's about long-term income and appreciation. And you got to be in it for the long term to make it work. And if you've got a consistent covered dividend that's paying, boom, sleep well at night.
Yeah. Yeah. Super cool. So this is going up. You got, I love that you're battle ready, battle born group of 11. You guys have been in the game. You've done a few different things. So now it's under value, right? So you're going, hey, this doesn't make sense either. Didn't make sense at 80. It's not making sense at 1473 as what I'm seeing it now, right?
Yeah.
So what goes through your mind when your value dips below what you think it should be, based on your NAV and based on all your analysis? Like what are your thoughts there?
Yeah, there's days that you wake up and you look at this stuff, because I live in the West Coast, and so the market trades, it opens at 9:30, so 6:30. I'm up a little bit before that. I'm looking at the trade starting, and then 500 shares might make us go down 2% or might make us go up 2% because we don't trade a lot. And when it's really down, you're like that. Some days, if you're not careful, it feels like a punch in the gut, right? You got to remember that it's Mr. Market, as you know, as Warren Buffett and Ben Graham used to talk about. Mr. Market doesn't necessarily very emotional, fear and greed.
Yeah.
And we get it. And there's a lot of different players who are, some people are buying for some reasons, some people are selling for other reasons, and it doesn't mean one thing. But when you see it get knocked down, it doesn't feel good. I got to admit, you're frustrated. You want to tell the world, hey, this is worth more. There's dollar bills on the ground. Pick them up, right? That's kind of what you want to say. Like, there's dollar bills, and that's what I do. Every time I reinvest my dividends, I take money in, I keep buying shares because like this is money good. I like money good. At least that's my personal view. I put all my eggs in my basket. I spent a lot of time focused on it. That's how I view. Like I treat people's money, and look, I hate it when it's down too. Yeah. I take it personally. Like, damn, I wish I could have made it better. I treat it as if that was my mom's money or my grandma's money, and that's all they had. And I don't want to screw that up. So we're very thoughtful about the decisions. But that said, when you're a small company in a really rough market, it's hard. It's a real challenge to make the right decisions because so often small companies either become smaller companies or they get gobbled up, right? Yeah. And if we get gobbled up and they close that value gap and someone buys us, closer to where we're really worth, fine. All our investors win. But in the meantime, I got to keep fighting so that we become a bigger company.
Yeah. So speaking of fighting, your latest earnings report, you talk about calf kicks, and like you take a unique approach on how you share your information out there. How does calf kicks and investing in industrial U.S. made companies, like how did that even align? Talk to me about that.
Yeah, and that's probably a byproduct effect. I've been for well over 20 years, certainly 20 years for MMA, and even longer as boxing. I've always been a fan of combat sports.
Yeah.
And I love the analogies that can come from, two honed athletes put themselves together and fighting it out, right? There's a lot of parallels to daily living. And well, anyway, calf kicks is just talking about, hey, we've done a lot of great things. We've changed our portfolio, we've grown, we've closed that bag. Our stock, as I mentioned, is up 40% year to date, in the last year, excuse me. And so we've done good things, and we're fighting the fight, and more people are hearing about our story, and we're just not, we're not afraid to keep fighting. But sometimes you get injured, right? You get kicked or you get punched in the face. And what I talked about is how, as UFC's evolved, particularly the calf kick has become the jab for your lower body. So we all know in boxing, if you keep jabbing, you can keep your opponent at bay. Maybe you can do some damage. You keep the distance, and you get yourself ready to set up that other strike. Well, a calf kick is the same thing. And if you've ever watched a UFC fight, a couple loaded kicks into your calf, you can't even stand on it, right? And so what we talked about is we bought an asset that didn't turn out right. Right. And instead of just sugarcoating everything and talking to you only about the things we went, wow, I said, hey, it was like getting kicked in the calf. And a good athlete, someone who can be a champion, gets kicked in the calf once or twice and then says, hey, I'm going to change my stance. I'm going to check that kick. I'm going to do something that doesn't allow me to happen again. So they improve their game. So a lot of times people say any form of adversity means you're failing. To me, that means I'm getting better. And so what we talked about was very candidly saying, hey, there was a property we bought. They tried to do a de-SPAC. They timed it wrong. It didn't work. They ran out of money. They're filing for bankruptcy. But we have a property that's still money good, right? It's what we put into it. It's well below its appraisal, and we've got people interested in it, and it's an over-improved property now. But those things happen, right? Even my 25 years doing this business and having gone through GFC and gone through different cycles and started out doing real estate at BlackRock institutionally, the learning cycle in real estate is long. And so you always try to avoid mistakes, but when you do get them, you try to learn from them. And so that was the story I was talking about, trying to relate it to something where people understand that you can get kicked in a calf and it can really effing hurt, but it doesn't ruin you. You can still fight.
Yeah, I think, I see a lot of CEOs when they talk about a mistake, right? They'll try to sugarcoat it, they'll try to hide it, they'll try to avoid that. And you just took it right in the ring, right? Like, let's go and let's just talk about it. We made a mistake.
It's real. Yeah.
And it's a mistake. So, because of that mistake, what how do you approach the fight differently, right? You got kicked in the calf one time and you're
Yeah,
like,
yeah,
that shit hurt. What'd you
yeah.
do differently?
Yeah, and I talk about that. So the lesson I learned from that is what this was a property based in St. Paul, Minnesota.
Mhm.
Great location, bought it really smart. They improved it there. This company was an indoor vertical grower. So they're growing microgreens and arugulas for in markets that don't have year-round growing seasons.
Mhm.
And they were running and gunning. They put, close to $15 million of capital improvements in there, added refrigerated space, it's built on top of an awkward, really good building. They just ran out of money because when they did the de-SPAC, a lot of people don't realize this, and I'm sure you've covered this, is that the SPACs, when they came out, a lot of them were left with legal bills, right? And the investors had the right to take their shares back. And so this happened right in the middle, early last year, worst possible time. People are like risk off, right?
Yeah.
SPACs were failing. And so they got cut short, and they had to stop paying rent. But we have a property. So what we learned is we wouldn't do a pre-revenue business unless it had substantial credit behind it, right?
Mhm.
Great that the vertical grower, we see the benefits of it, but it was nascent. It's still not, we don't have the 800-pound gorilla in that space yet. And so that was a lesson learned there. And the other one is, let's just, make sure that they don't have that financial. And the other part was it was a related party transaction. We got sourced from someone we knew. We won't do that again. Didn't affect the decision, but it doesn't look good. And so I have to be really transparent and honest with my investors to say, hey, that one I got wrong. We're not hurt from it yet. There's no economic loss yet. I don't think there will be either, but I got it wrong. And so I need you to know that I got it wrong so I can be admitting of that and I can make it better so that it won't happen again. Because if I don't talk about it and it's there, there's going to be a discord. And I don't want that.
Yeah, for sure. Now you've got skin in the game in this too, right? Talk to us about, being a CEO, publicly traded company, also having skin in the game. Why is that important?
I think it's really important. And there's a lot of people who look at these metrics like insider ownership. And that's why we have these Form 4s. The SEC makes us do a Form 4. Anytime I buy or sell a share, I got to report it right away. And I just buy shares as frequently as I can, consistently as I can, because if I'm not willing to have my interests aligned with the shareholders and that do well in the stock, then I'm not really well aligned. And the REIT space particular can be prone to people, just taking in salaries and managing these portfolios and not really trying to make their investors more money. And so I want my interests aligned. And it's just how I am. Every company I've been, I've always tried to take any form of compensation I can in stock. And then I also invest. So and I feel the pain. Like when we were at 25 and before, I took, $1.5 million of my own dollars and just bought company shares back then, well before we knew we were going to list and all these things like that. Right. So I feel the pain just like our legacy investors.
Yeah.
That's what makes me even tougher and better. And it's also the thing is I got my eggs in this basket. I'm thinking about this 24/7. How do I make it better? How do I do? And so, I think the investors win in that regard.
Yeah.
Yeah.
Yeah, I love this. Now, you at one point you took a public company private. What does that look like? I have not done that, and I'm curious as to why would you do that, and what was the process, and what did you learn there?
Yeah, that was an interesting. Could be a book about it. So the company I had joined as a chief investment officer was called Campus Crest. Campus Crest was based out of Charlotte. It was one of the 3 student housing REITs at the time. This was go back to 2014.
Mhm.
So I joined them. They had already been public for a couple of years. Their share price was really lagging the market. They were a vertically integrated student housing. So they would buy the land, build this thing, and then own it.
Mhm.
But they had levered themselves too high. Their balance sheet was kind of a mess. The story was kind of a mess. And so I came in there, started working. What I didn't know until I got really into it, that it was probably more messier than we thought, which resulted in the CEO and the CFO getting ousted, right? So then we got this high drama thing, this one of only 3 student housing REITs. We had activism going on. We had a joint venture that hadn't been completed. And so for about 2 years, I literally slept on the couch in the office. And we just worked and fixed problem after problem. And what could have been easily the demise of the company, where you would have had wiped out the equity, what we eventually did was we ran a process and we got it sold to Harrison Street, which is a very large and prominent private equity shop.
Yep.
and, returned capital to our investors and, paid off the debt. And it was a journey where you had, the process to go private is typically in REIT land, there's a lot of social issues, right? It's hard to do M&A with REITs. It's hard to do to take something private if they don't want to, right? And so, what I did is I tried to align with the shareholders. That we had a lot. We had common shareholders, we had debt holders, we had preferred holders, and so you have a lot of different constituents. It's like, how do we not be stubborn and destroy value, right? And how do we exit? And so what happened is we were the first of the 3 student housing REITs. There are now no student housing REITs out there because ultimately this is an asset class. It's probably better private because you take high class, class A buildings, you get them all fresh for the beginning of the school year. You give someone who's got no economic maturity or and maybe limited physical maturity, they destroy the unit, and then you got 2 weeks to turn it around and do it again, right, at the end of the school year. And it's kind of a crazy asset class. So it's now private across the board. They were all taken private, but we were the first, and it was a fun journey, even though it probably created a little bit of scar tissue.
Yeah, I bet. Well, as a deal maker, you learn from getting kicked in the calf and taking stuff on the chin, and it makes you resilient, but it also, I think, makes you a better deal maker, a better investor, right?
Yeah.
So now you had this next opportunity to be CEO of a publicly traded, company. Before you said yes, what was going through your brain, like, before you said yes and accepted that role?
Yeah. So, what I sort of looked under the hood, kicked the tires. I've learned as my evolution goes on, where you sign a non-disclosure agreement, you get access. You want to make sure you know what you don't know, as opposed to just relying on what might be publicly available. I talked to people there. I looked at the assets, and I thought, is there a path forward? I think the key, how I work, generally speaking, is I always try to underwrite the worst case scenario. And if I can accept that worst case scenario, then I try to incrementally improve upon that, right? So that the outcome will be better. And that requires you to think iteratively. Like there's branches in your different, binomial sort of branches in terms of, if I say yes to this, what does that mean? And things like that. So it's a lot of iterative thinking. But I looked at this and I said, hey, do they have fundamentally good assets that weren't terribly mispriced? Meaning that they hadn't way overpaid for them. That their leverage wasn't too high, and that there was what you call good bones, right? And if you think that, and there's opportunities in the past where I've said, no, thanks, this is a Hail Mary that I don't want to try to attempt, right? It doesn't mean it doesn't come with a lot of work and had to roll up sleeves and get things done. And we've done that. And I liken it to, like, if you're walking out into a field and you take a rock and you turn it over and there's a bunch of squiggly things underneath there, right? You kind of have to do that. You got to turn over the rocks and say, okay, what do I got here? And we did that systematically, and we're still in that journey. We're towards the end of that journey in terms of cleaning it up and making it better and making it sort of relevant. But it's been a 5.5-year journey.
Yeah. Started out as a mini IPO, right? You did crowdfunding back in the day, if you bring to the origin of the story.
Yep.
Now, for people out there who are looking to, raise money for their company, and they're looking at the crowdfunding versus maybe, IPO and going traditional friends and family, A, B, C, right, to public, right? What are some of the things that you've learned along the way, and some advice you could share with people? Here's, if you want to go crowdfunding, here's some things to look out for, and if you want to just do this more traditional path, this is what I would look out for. What are your thoughts?
Well, there's 2 ways to think about it. There's the investor side, and then there's the sponsor side, right? From the investor side, there's basically 3 primary ways you can own real estate. You can own it direct title. That's with you or some buddies or not, but you own title, so you have ultimate control and ultimate responsibility, right? You got trash and toilets and all these things you got to deal with, but you can decide all the things that you need to decide on. The middle route is sort of this semi-public private fund route, where you typically have a GP and an LP, and you're in a fund. Those are finite life. You're going to give up control, but you're also going to give up responsibility on the margin. But it's going to have to go full cycle. Right? So there's a inherent trade involved. If it's a 3-year deal, a 5-year deal, whatever, it's a trade. The last bucket is publicly traded real estate, which is what we're falling in now. And that is permanent equity. Now, I can make an individual decision. I have control of when I want to get in and out of this. I don't have control of the price. I don't have control of the operations, but I also have no responsibility, right? I have full liquidity. I can do whatever I want. Depending on what you want to own, There are certain types of assets won't fall in the public bucket, and they won't fall in so that the other two buckets. Now, the individual buy your own property, you can't crowdfund. The fund space is the crowdfunding, right? That's the sort of semi-public private. It's aware. Sometimes they're doing Reg A's and they're filing. Sometimes they're not. But it's the mechanism that you get it. You have to go to a portal. Crowdfunding has changed so much in the last 11 years, right? We've seen a lot of them go away, right? Some of them consolidate. And so the nature of crowdfunding has changed a lot. But if you look at the history of crowdfunding, almost all the deals were multifamily. And why is that? Well, because two guys can easily identify an apartment complex. Maybe they've worked on it before. They understand the model. They can go get 70, 75%, government-backed financing, which is a high leverage profile. Like in our profile, we're 48% levered, right? Our minimum property is probably a $15 million purchase price and going up. So you can't jerry-rig a small manufacturing bootleg it, right? It's a bigger scale thing, so it's conducive to that public market. But if you did these things, and then they renovate the units and they get higher rents and it works great until if rates stay. We're starting to see some capital calls in some of those crowdfunding deals, but a lot of crowdfunding was multifamily. So it depends on what you want to buy. If you're a sponsor, it depends on how big you need to be or how much capital you need. If you need a lot of capital and you need it consistently, public markets, right? It's always the cheapest form. It's the most expensive to run, though. A publicly traded company has public SEC costs and has audit costs and has a lot more brain damage and a lot more skill required than it does to go buy an individual property or to do funds. So it depends on where your risk and your proclivity is and what you want to do. But they all work. They're all viable, and they all worked together.
Mm-hmm. Yeah. So when it comes to running a public company, you mentioned the cost to do that. You got your PCAOB stuff, you got your 10K, 10Q, anytime, earnings. You have to do a lot of work just to keep it. And you also have to keep certain thresholds out, for NASDAQ and yep. such. For the, the mini IPOs, the Reg A's, the Reg A pluses, and for that, there's less like reportings and audit stuff that you have to do, but there's a thinking, and I'd love your opinion on this. Mm-hmm. If I can lower if I could increase the pool of capital by making anybody can invest for $100, right? Mm-hmm. That I think that hit us with crowdfunding. I think a lot of people thought that just because anyone could invest for as little as $100, that there was going to be this massive flow of money coming in.
Right.
Did that happen? Did you guys experience that, or were there some learnings there?
Lots of learnings there, and I think for the space, I mean, I've touched Reg A plus before. I've done some Reg A's. I think the idea behind Reg A on paper when it first came out with the Jobs Act was brilliant. It was meant to work. It didn't work as well. The cost to do a 6-month filing where you have 1Ks and 1Qs versus 10 quarterly is less, but it's still high, right? Yeah. You still, if you're going to be public, you still have to go through the SEC rigmarole, right? And it's there for a reason. The SEC rules are meant to protect investors. Some of them are more arduous than others, right? So in the last 6 months, we've had the climate disclosure rules come out. We've had, cybersecurity rules come out, and these add so then you got to go hire a consultant, and it costs a lot of money. So even if you're a Reg A, you still have to do these types of things. Yeah. And I think to your point is just because someone can come in for $100 and they don't have to be accredited, doesn't mean you're going to get them. And people forget that customer acquisition costs or investor acquisition costs are real. And then if you're a crowdfunding company started from scratch, you got to spend a lot of money to get people to pay attention to you. Right. And say, why would I go there versus I already have my Edward Jones advisor, or I go onto my Robinhood account and I can see all these things. And you got to say, I got to fight for viability. And so it's a lot harder than people think. It would, and so many big and small companies have tried it and with various levels of success, right? There's a handful of Reg A plus out there that have gone sort of like GIPR is a publicly traded company on the NASDAQ. They started as a Reg A plus. They're still out there. They're gotten bigger. They got a $20 million market cap now, but it's been a fight, right? And I think in hindsight, they probably wouldn't have done that route.
Yeah. Yeah. It's such a great idea. And this idea of democratizing and lowering the investing route, it's such a good idea. And I would love to see people do it well. And I have a few friends that run these kind of companies and I'm cheering them on. Yep. And, some are doing well and some are not.
It's work. It's
It's
work.
work.
It's not a panacea that people think it was, right?
Yeah.
It's a better, it can be a better vehicle to offer more opportunity for more investors, but you still gotta track them,
Yeah.
right?
And what I'm not doing is I'm not giving financial advice here. You know, what I'm saying is as I'm learning this stuff, like I learned the pros and cons, and I'm invested in both sides of it. And I think that this is such a cool world what I'm learning. And I could even my brain's like a diesel engine because I'm learning, you know, I'm going through investment banking licensure and such like that. I'm learning a ton. When it
Yeah.
comes to you learning, talk to us about your learning journey. Like, how did you get into chief investment officer, CEO, publicly traded company? Because man, I feel like I've got so much to learn, and it's a lot. So
Yeah.
how did you approach this, and what was your journey like to get there?
My journey's been very nonlinear. So, you know, flashback to I was in high school in Hawaii and got a job at a real estate office, a Remax agency. And this is, I'm dating myself quite a bit here, but this is when they used to do bulk mailing. So you'd print out
Yeah.
bills on a dot matrix printer and you put out a bunch of addresses. So I started out just doing real estate, got my real estate license really early and loved real estate. Back when the Nikkei and the yen were really strong, I was trying duplexes and fourplexes to Japanese investors, and that market went poof. And I was like, oh, wow. You know, and I just, you know, I was so didn't know, you know, it was just going up and you didn't, you know, and then it went down and there was really no way to short real estate in that context. So you couldn't make money on the downturn unless you waited until it hit bottom. And then
Yeah.
I joined the military. I was in the Air Force a little bit and then got out and then, hey, decided, hey, I need to figure it out. So I went, got a job at Charles Schwab, became a broker at Charles Schwab, did that a little bit. Hadn't even gone to college yet. And then I didn't go to college until I was 26. And then I did my undergrad in accounting, plowed through that in 2 years, and then went right into my MBA at Rice, got an MBA in finance. And then there I had, they didn't hire, Rice wasn't getting hired on Wall Street. I mean, it was a good school, but they were all going to Enron and El Paso Energy and all these things like that. But I got a job at Lehman Brothers back when Lehman Brothers still existed.
No kidding. Yeah.
Yeah, and this is during the dot-com era. So this is before, this is 1999, got out of Lehman Brothers for the summer between your first and second year of the MBA. And there were 7 Rice alum. And so I had dinner or drinks with all 7 Rice alum on there. And I was just networking and working hard. And the last dinner I had was with a gentleman by the name of Keith Anderson, who was a co-founder of BlackRock. And he said, hey, we don't really hire MBAs, but you should come look it out. So I joined BlackRock. This was when BlackRock had 200 billion under management, 500 employees. You know, what are they? They got 10 trillion now. So they've grown quite a bit. And we were right below Blackstone on 345 Park Avenue. Started out working there, didn't know anything what I was doing. You know, I got to work on the fixed income desk, modeling current default swaps and doing things like that. And it was really intriguing to use your brain, but it was boring because fixed income is like little tiny basis points movements. And I'm used to real estate, which has got some, you know, there's optimism and some sex to it. So eventually I leave BlackRock. I go to a firm called Green Street. Green Street is a research firm in Southern California, right? And I was there for about 18 months and then went back to BlackRock when BlackRock acquired a real estate. So I've done in these things is I did client work, I did modeling work, I did, you know, business development, I did portfolio management, and then I became chief of staff at BlackRock real estate division, helped organize the company, you know, get meetings done, just the real basic things. I was a young guy. Did product development, structured REITs. So I learned how to build REITs and put things into them and get them launched and did that. And then I left, went to a company called Cole. Cole was out of Phoenix. COLE was one of the largest non-traded REIT shops. Helped them sell a portfolio to another company, internalize their manager, list it, and then sell it to another, you know, which eventually is now part of Realty Income. And then that's when I jumped into the chief investment officer at Campus Crest. And then when I came out to the West Coast again, you know, I did the crowdfunding thing. I just jumped into that. So I've taken a lot of linear paths. I've done public, private, debt, equity, retail, institutional, and each step along the way, I was like, how does this fit in, right? Because I've seen guys who had one gig and they stayed all the way through and that's how they got there. And I was like this and that and that. And I think what it was is I wasn't aspiring to be a CEO or a chief investment officer or do that. I just had this insatiable desire to learn and to get better and to really hone it. And it's like a craft, like any craft. Now I've been doing this for over 2 decades. And so I'm just now starting to feel like I've got a mastery of a lot of the nuances of running a REIT, of trying to do the right thing. And each day is a humbling day, right? Each day you're like, how do I make this better? How do I do it better? And that's just my DNA. And so I don't know where the future will take me, but I do know that, my being able to make decisions, which has a lot of stress, but you're knowing that you're trying to do the right decisions for investors, and you're trying to do that every day, it's rewarding. And so if I'm doing that and I feel rewarded and I can do a good job for investors, then I'll keep doing it.
Yeah. So you met with the guy, the alum, the last one right before, and he goes, "We don't hire MBAs." Like, what was going through your head when he said that? Like, why did he approach that? Why did he say that? Or she? I just assumed.
Yeah,
Right?
it was a he.
Okay.
Yeah. So Wall Street typically they have an analyst program and they have an associate program, right? So if you go into an investment bank, you right out of undergrad, you get into the analyst program, and usually that's a 2-year up and out, right? So after 2 years, maybe 3 years, depending on the program, if you're not selected to go up, you're out. And so what happens is a lot of the analyst program, they go there for 2 years or 3, and then they go on to business school, right? And this is a well-run process where, all the Ivy Leagues feed into it, and you got your undergrad at a great school, and you go to get your MBA at an even greater school, and then you jump off and you either go back to banking or you go into PE or hedge fund or something like that. So most of them have an analyst program. Some of them, if they're really bigger organizations, have also an associate program. So the associates they go recruit on campus for MBAs, and they hire them. And then this is a fast track. Ideally, you're a little bit more seasoned and they're going to get something out of you. BlackRock was relatively small at that time, and they didn't have a formal need to be hiring associates, because associates or MBA programs tend to be costlier. You have to have more organization. They were into an analyst program. So they called me an associate, but I was stuck with the analyst program. And you know what? I didn't give 2 Fs, because I just wanted a chance to learn. Here I was at a shop that I was a Rice alum, and it was great. And I learned a lot. I learned a lot from the people there. One of my biggest mentors her name was Barbara Novick, another co-founder of that firm. She taught me a lot. I don't think she knew she was teaching me a lot, but she taught me a lot about how to do and act. And I'm certainly no mirror of her, but I learned a lot in that organization. And so, it doesn't really matter what the title is. It doesn't necessarily matter what the pay is. It really matters what the opportunity is.
Yeah. Yeah. Super cool. I have a office at the home, and I'm looking and I see my 6-year-old son just staring at us like, I think he's going to come say hi to you. Yeah, come here.
All
Do you want
right.
to say hi to my friend? We're on a podcast. Come on.
What's your son's name?
Hold on, Zeke. Say hi.
Hi.
Hi, how you doing?
All right.
Good.
What advice
I like
do you
the
have?
shirt.
Yeah, say thank you.
Daddy, Mama's stuck.
Okay, I'll take care of it. All right, shut the door, buddy. I'll go give him.
I got 4 kids myself.
Usually, like when I'm doing an interview, it's either "Dad, wipe my butt" or something like that. Well, cool.
I love it.
So, Aaron, man, I absolutely love both our conversations. I think I've got to go take care of some family duties right now. So, for people who want to connect with you, do a deal, and maybe check out more about what you guys are up to, where could they go to find out that information?
Modiv.com, MODIV.com. That's our website. You can also find us, there, you'll find an email there, management at Modiv.com. You can send us emails. We'll try to respond to every one if we can, as fast as we can. If you want to look about what we do, what we did, go to the investor section, read the press releases. All our stuff's publicly available. We're no nonsense. You're going to find our style to be very folksy. That's not a gimmick. That's just who I am. I can't be anything but genuine, right? And some people are going to love it, and some people are going to hate it, and that is what it is.
Yeah, nah, dude, I love your style, and I love your transparency, and I'm so thankful to have this time with you together.
Me too.
And hopefully we could do some more. For the world of deal makers out there, as always, reach out to our guests. Say thanks for being on the show. This is super valuable that they share their time with you. So connect with them and say thanks. And if they're working on something that interests you, their contact information will be in the show notes below. If you'd like to have a conversation on the Deal Scout about the deals you're working on, head on over to thedealscout.com, fill out a quick form, get you on the show next. Till then, we'll talk to you all on the next episode. Bye, everyone.